5 seconds to the open. You ready?
Who wants to get this thing started right about now?
Welcome to Follow the Money Weekly with your host, Jerry Robinson.
Welcome.
Not just some guru.
Oh, really?
Your host is an economist and a best-selling author.
What an interesting news item. I'd better write that down.
And just someone who likes to make money and help you to make money. Welcome to Follow the Money Weekly. And here he is, Jerry Robinson.
Friends, welcome to you all around the world. Welcome to Follow the Money Radio. So grateful to have you here with us along for the ride. We have a great program lined up for you today. In fact, today we're going to be focusing specifically upon the new trader, the new investor. You know, there's so many people out there who are just getting started in the world of investing and in the world of trading. And we get to hear from them constantly here at Follow the Money. We get many new emails. And Jennifer, I know you're the one who receives a lot of these emails. We are constantly seeing people who are just taking a new dive into the world of investing or trading. And of course, when we think about trading and investing, we think, of course, of stocks. But there's so many other things. There's commodities that you can trade. There are currencies that you can trade. You can trade global equities, so you don't just have to trade the U.S. stock market or the Canadian stock market. You can trade globally. It's really a fantastic thing, and we've seen a lot of demand from new traders over the last several months.
We have, and the new traders specifically want a system. They want rules to follow, just like, and I don't mean to compare people to children, but it's very similar to children. When they're learning new things, they need the rules to be set. They need the boundaries. And it's a similar concept, even though you're definitely not children if you're a new trader or investor. But you need a system to follow, and that keeps the fear out of trading and investing is by following a system. And today we're going to be talking about Jerry's top 10 trading rules that go right into our system that we've been using and that Jerry has been using for over 20 years. And those 20 years, he has made the mistakes that you can avoid, and he has come up with these top 10 trading rules.
Yeah, you know, it's so true that you really can't know what you don't know until you learn it. And there are so many things that new traders can learn from the mistakes of those who have been before them. I tell you what, I've made a lot of mistakes in trading. When I first got started trading, I was day trading. It was back in 1996, 1997, in the run-up to the big dot-com bubble. And so I saw some really interesting things in the stock market, and I made some pretty big mistakes. I mean, really bad mistakes. And we won't go into all the mistakes today on this podcast. We want to stick to the rules today, but let's go ahead and dive in. And by the way, I want to give you a heads up on this. We are actually making these top 10 trading rules available for a completely free download that you can go to followthemoney.com/trading rules. And there you'll be prompted just to enter your name and your email, and then you can hit download, and you'll get access to this beautiful, I think it's 12 or 13 page report with all top 10 trading rules in it. So if you want to go download the list right now, go right ahead, followthemoney.com/trading rules. And again, it's free, there's no cost, and I think it'll really be beneficial to you.
Yeah, that's a great idea. You can even follow along with the podcast and download it and follow along if you want to. So let's just dive in now to trading rule number 1, Jerry. Trading rule number 1 is know the current market conditions before trading. What exactly does that mean, Jerry?
This is a huge rule that I got to tell you, over the years, if you ignore this rule number 1, you're going to have a lot of pain in your trading account and also in your investing account. If your goal is to earn money from the financial markets, then don't fight the general market trend. That's exactly what that trading rule number 1 is all about. So before placing a trade, the first question to ask is, what direction is the current market trend? And so, The reason that this is so important and the reason why we have our market tracker service, which is available for all of our bronze members as well, all the way up to our platinum members, it's a very important service that helps you know which way the wind is blowing in the stock market. The reason why is because historical data has shown that 75% of stocks tend to follow the overall trend of the market. So if the market trend, like maybe in the S&P 500 or the Dow Jones, is in a downtrend, then you can expect 3 out of 4 stocks in that particular market to be following the overall trend of that particular index. So this is extremely, extremely important. And you know what? In fact, what I like about this particular rule is that it helps you kind of rely less upon the corporate news and instead to learn to really pay attention to the chart, right? Before placing a trade in a U.S. stock, I know the current state of the S&P 500 index. So anytime I buy a U.S. stock, I got to know that. I got to know exactly what's happening in the broader market. If your goal is to make money from the market, again, let the trend become your profitable trend. Trading rule number 1, know current market conditions before trading.
Right, Jerry. It kind of makes me think of checking the weather before you start making your plans. If you want to have a picnic, you're not going to make the plan on a day that rain is forecasted. It's a similar concept.
Exactly. And if you want to go short a stock, you want to get bearish, but the market is moving higher, then you might want to check yourself. You might want to say that might not be a smart idea. So what is the current market trend? That's rule number 1. And once you learn how to do that, it's going to put you miles ahead. Okay,
rule number 2, Jerry. Plan your trade and trade your plan. So we just talked about how every new trader and new investor needs a system, they need rules, and trading rule number 2 is about making that plan.
That's right, Jennifer. And this goes back to one of the podcasts we recently did about, are you afraid to trade? The fact is that if you develop a trading plan, you can control your emotions. You can conquer your fears of the market. You can conquer your fears, and I'm talking about irrational fears. You should always have a healthy respect and a healthy fear of the stock market because it is a very volatile place. It certainly can be. But at the same time, there's a lot of irrational fears that can be eradicated when you have a trading plan. Most traders fail because they don't have a trading plan. And because they don't have a trading plan, they're held hostage by their emotions, which inevitably lead to losses in the market. I remember when I first got started trading that emotions were really what were driving me. When I had a good day, I felt like King Kong. I felt like nobody could take me down. And then I would go out and I would trade again, and then I would get hit, and then I wouldn't trade for several days because I felt bruised and my ego was hurt and my pride was hit. And so it's one of these things where you cannot be thinking about your emotions. It's not about that. It's about going out and actually running a real business like any other business, and you have to remove the emotion from it and instead focus upon a real plan. Now, you may be surprised to learn that most traders don't have a plan or a strategy, but that's because many retail traders approach trading as a hobby, and therefore they don't invest the necessary time and energy to develop their entry and exit strategy, along with a set of money management rules such as stop-loss orders. We'll talk about stop-loss orders in a minute, Jennifer. But that's really important. Develop a trading plan. Rule number 2, plan your trade and trade your plan.
Okay, let's move on to rule number 3, Jerry. Rule number 3 is avoid low-volume stocks. This one is really important.
It is, and I want to stress also for those of you who are listening and you say, I'm an investor, not a trader. This applies to you too. Many of these rules are going to apply to investors and or traders. Avoiding low-volume stocks is key. I prefer to trade stocks that have at least 400,000 shares in average daily volume. If I'm going to really be looking at a stock and it has a lot less than that, then I'm probably going to choose another stock. And if the stock price is less than $5, like if it's a penny stock, then I'm going to raise my minimum volume requirement to about 1 million shares. This is so unbelievably important, especially for newer investors and newer traders, because sometimes you'll see stocks kind of banted about online, or you'll see them, promoted in a magazine or a newsletter or whatever, and then you'll go and you'll look at the stock and begin to examine it, and you'll see that hardly anybody knows about the stock, which may be good, but that's also kind of bad, because there's not a lot of shares traded. And therefore, if you buy the shares on a low volume stock, you may not be able to sell them very quickly. And so if something happens to the stock, if something negative happens and there's not a lot of volume there, then you may not be able to get in and out. Think of volume as like the number of buyers and sellers. That's really what it is. Is this stock liquid? If it doesn't have at least 400,000 shares of average daily trading volume, I would be very careful, especially as a new trader. So low volume stocks, trading rule number 3, just avoid them.
This is also a good rule that helps you narrow your decision on which stock you're going to trade. I get a lot of questions from members about how there's so many stocks out there, it's so hard to choose. Well, avoiding low volume stocks will really help reduce the number of stocks that are in your pool to choose from when you're researching a trade. Trading rule number 4. This is keep a trading journal.
Very important. In fact, those of you who are members here at Follow the Money, you know that I make a trading journal available to you, like a daily trading diary that's available where I pick out a stock every single day, provide you with the entire setup, the entry price, the exit price, the stop loss price, the whole 9 yards. And it shows you kind of the thinking that goes into trading. Over the past 20 years of my trading career, I have learned the absolute importance of keeping records of my trading activity. Because without a record or a journal of your previous trades, it can be difficult to remember which strategies worked, which ones didn't. And all functioning systems require a feedback loop to make meaningful improvements. So your progress as a stock trader is going to be thwarted or stunted if you don't have some way to look and see what's working in my trading, what's not working in my trading. And so a feedback loop can take the form of a trading journal in which you record all of your trades, and after each position closes, you can return to the journal entry and discover what you did right, discover what you did wrong, and you may be surprised at what you discover and what you uncover as you look at that trading journal. I like to look at mine going back years and just to see some of the dumb mistakes I've made over the years. And that's okay, because as long as you recognize it as a mistake, you can correct it. But without a trading journal, you're not going to remember the mistakes and you might end up repeating them.
Right. And this process of keeping the trading journal can also help you discover the stocks that really follow the charts properly. So if you trade Apple, for example, and it seems like more of those trades work out for you, then you might discover you like trading that stock more than you like trading another stock that seems to not follow the trends as well as other ones.
Yeah, that's so true. Every stock has its own temperament. We can often think of stocks as like individuals or humans or people. They're kind of temperamental. Some of them are happy stocks. Some of them are not so happy stocks. Some of them are baby stocks. Some of them are older stocks. And they all kind of move according to their own beat. They all end up following the trend in the end, but some of them were more stubborn. And so what Jennifer's saying there is very, very powerful. So rule number 4, be sure to keep a trading journal.
Okay, rule number 5. This one has to do with risk management. And this rule is to always use stop-loss orders. Jerry, expound on this.
Yeah, one of the most common trading catchphrases is cut your losses short and let your winners run. And everybody's heard that who's ever been around trading. And this is so key. But how do you cut your losses? Do you let the stock go down to zero and then sell it, try to liquidate it? Of course not. The way that you can actually protect yourself from an erratic stock market is through the use of wise money management principles, and one of those is known as a stop loss order. This basically is a specific type of order type that instructs your broker to automatically sell your stock if it falls to a price as specified by you. So you may buy a stock at $52. And you may be looking at the charts and you may notice that every time it comes down to $48, it seems to rebound. And every time it comes down to $48, there seems to be some strength. Well, you might think to yourself, well, if the stock goes below that area, maybe like 47.75, then I might want to sell it because typically it jumps at 48. And if it goes below that, then it may not, right? So you can instruct your broker to say, look, if this stock goes below $48, say 47.75, then sell it. automatically sell it. I may be at the grocery store when that happens. I may be at work when that happens. Just sell it for me. And you instruct the broker ahead of time, and then it's all set. So you don't have to worry so much about the stock going down, and then you get home from work or whatever, and you look at your account and you say, oh my gosh, I wish I would have known. The stop loss order will protect you. This is something that many, many investors and traders do not use, and everyone who becomes a member here at Follow the Money gets their head filled with this very important principle. I talk about stop losses all the time. Rule number 5, always use stop loss orders.
And these stop loss orders literally take less than 60 seconds to enter into your brokerage account, so they're very simple to use. Okay, as a reminder, before I go on to rule number 6, you can download all 10 of these trading rules in a beautiful PDF report. You can download it to your Kindle or to your phone at followthemoney.com/trading rules. Okay, let's go on to rule number 6, and that is to pyramid into your positions, but don't ever average down.
This is an old rule that many traders have long stated. It's so vitally important that you don't average down. Instead, you average up. Averaging down is an old investing idea that says that you should add more shares to your position if the stock goes below your initial purchase price, so as to improve your overall cost basis. You've probably heard this all the time from Wall Street, and financial advisors love this idea. You buy a stock at $50 a share, and it goes down to $48, and the average down approach, would basically say, well, go ahead and add more because now it's on sale, right? This is a dangerous idea, and it directly conflicts with the pyramiding strategy that most of the greatest traders throughout history have used. Instead of adding more shares when a stock that I am trading goes down, I usually sell it. When I buy a stock, I'm speculating that it's going to rise, not that it's going to go down, right? So I try to time my purchases properly in the stock market for stocks that are going to go up, right? That's why we buy shares of stock. We don't buy shares of stock for it to go down. So instead of adding more shares when a stock I'm trading goes down, I usually sell it. Don't fall victim to buying more shares of a losing trade. Be picky. It's your money. Why in the world would you chase a stock down whenever it's going down when there's plenty of stocks that are moving up? It's counterintuitive to most financial planning advice that you get, but if you look at the greatest traders who have ever lived, what they all advocate, almost every single one that I can think of, is that do not chase a stock down, right? Instead, average up. Don't average down. That's rule number 6.
And we have much more on this pyramiding strategy into your positions for gold and platinum members on our website. Okay, rule number 7, avoid opening a new position in the first 30 minutes of the trading day. This is something you don't hear a lot from other traders and investors out there. This one's really interesting and very specific to Follow the Money.
I used to feel pretty lonely in this one too. I learned this early on, maybe 20 years ago when I first got started trading. I noticed that in the first 30 minutes, the price of most stocks was erratic. And over time, I learned that that's just kind of amateur hour. It's actually just 30 minutes, but it's kind of an amateur hour where, all of the trades from the previous day that didn't get placed before the close of business are now being filled. You have a lot of new buy orders or new sell orders that are coming in that are being filled right there in the first 30 minutes. You have a lot of people coming in and buying or selling. And typically, if you notice the smart investors and the big money, they stay away from this first 30 minutes because typically this is a time when the bid and the ask spread, what people are wanting for the stock and what people are willing to buy the stock for and what they're willing to sell it for, are kind of stretched. And so this is a time whenever the market makers make a lot of money, but for smaller traders and investors, this is a time whenever you're probably going to get a poor entry into the stock market. And so if you look at the smart money and the big money investors, they wait for the last 30 minutes. They don't trade the first 30, they trade the last 30. And I learned this early on, but I always felt kind of lonely in this concept. It was just about a year ago that the Wall Street Journal put out a really important piece on this topic, talking about how much money investors were losing by getting involved in the market in the first 30 minutes. So I felt validated. The Wall Street Journal had done a story on this. But my favorite time to buy a stock is in the final 30 minutes of the trading session. My favorite time to sell is in the first 30 minutes of the trading session. So let me just say that if you're going to be doing anything in the first 30 minutes, I would be selling, not buying, because of all of the volatility there. So rule number 7, don't open a new position in the first 30 minutes of the trading day.
Okay, rule number 8, Jerry. If you have a small trading account, consider options, not penny stocks. Gosh, this is an area where a lot of new traders can really feel defeated, is getting into penny stocks when they're a new trader.
Yeah, it's so compelling. If you don't know anything about the stock market and you have a small account, you're going to probably very naturally feel drawn to those stocks that are cheaper, because you would think to yourself, well, gosh, it's a lot more realistic for a cheap dollar stock, trading for $1 to double than for a $50 stock to double, right? And you're trying to double your money or triple your money. You've heard all this stuff about trading and you're going to make a bunch of money. So you come in and you're looking for the quickest way to do it. And most people are just drawn to the cheap dollar stocks, penny stocks is what they're known as. And what I've learned over the years is that most people who end up trading penny stocks lose money. There is a caveat to that, or there is an exception to that, I should say, and that is that if you're shorting penny stocks, then you can actually do pretty well, because penny stocks are cheap for a reason, right? And most people would define penny stocks as those trading for less than $5 a share. So if you have a small trading balance and you're tempted to focus all of your time and effort on trading penny stocks, my advice personally is don't. As I mentioned, penny stocks are cheap for a reason. They're much more likely to fall in price than rise over time. You're much better off investing that time you would be investing into looking at penny stocks and trying to buy them, instead into learning options trading. When you use options trading properly, you'll find that they are less risky than penny stocks, and they can give you exposure to higher quality companies for the fraction of the price. So in reality, what the trader is looking for is he's looking for a way to maximize his small trading account, and he looks to penny stocks as the way to do that. But in reality, that's not the right solution. So if you have a small trading account, I would strongly urge you to consider options trading, not penny stocks. That's rule number 8.
That's a great rule. Fantastic rule. And we have many new traders who are having a lot of great success in buying call options on quality stocks. And they're making a lot of good profits that way.
Especially in this, fast-moving market.
Okay. So rule number 9, we have two rules left. Rule number 9 is to avoid stocks trading below a declining 200-day moving average line. Now, this one might sound a little daunting. It has some interesting vocabulary, but Jerry's going to break it down for us.
Yeah, so the 200-day moving average line, what is that? You hear a 200-day moving average. Well, the 200-day moving average line is a powerful metric that many financial institutions and hedge funds and other big traders add into their trading algorithms. So most smart traders avoid stocks that are trading below their 200-day moving average. And you can apply the 200-day moving average in any charting software. If you have an E-Trade account and they have a charting software, you can go up to the indicators and the overlays and just add a 200-day moving average line. And what that line does is it smooths out the price action and shows you how things have occurred. What's the average price over the last 200 days? And that's very, very powerful for you to look at. But it's also important to see, where is the price of the stock? Is it above that 200-day moving average line, or is it below that 200-day moving average line? And also, you want to know, which direction is that 200-day moving average going? Is it rising or is it declining? And so that's really, really powerful. And, I would say that this is probably not a hard and fast rule, in the fact that if I'm looking to sell a stock short, I would of course look for a stock that's trading below a declining 200-day moving average line. I want a stock that is, breaking down. I think it's just really important, though, to have a set of rules that you really focus on. And when it comes to the 200-day moving average line, it's one of the most powerful things that you can do as a new trader or a new investor is know where that line is and know if your stock is above it or below it. That's trading rule number 9. Avoid stocks trading below a declining 200-day moving average line. And I want to also comment, just as Jennifer had just said, all of these rules can be downloaded on our website for free. If you go to followthemoney.com/trading rules, you'll be able to download this completely free report and have it, in your hands and use it. Maybe even keep it by your computer. And as you're learning to trade and learning to invest, these rules will be indispensable to you. Trust me, after 20 years of trading, I tell you, these are the things that you need to know.
Okay, final rule. We've made it to trading rule number 10. And this one is so important. I recommend this to every single new trader or investor, and that is paper trade, paper trade, paper trade. And you can say it another way, and it's just practice, practice, practice.
Yeah, just with all things, no matter what you're trying to do, you're going to find out that, the practice makes perfect, right, as they old say, right? The good kind of practice makes perfect. And when it comes to stock trading, the same way. Before you use your own hard-earned money to speculate on Wall Street, I strongly, strongly advise you to first test out your trading plan, test out your strategy on paper for a period of months, at least a period of weeks, but I would even say a period of months. There's no rush. There's no hurry. Don't get caught up in the idea that what's happening now will never happen again, right? That's oftentimes leads people to the poorhouse. Don't think that there's never an uptrend. Right now is the only time to trade. You can't trade any other time. This is if you don't do it now, you're not going to make money. That is not true. The market has been making people money for a very long time, and it will continue to, even if the market goes down. So some of you out there listening saying, well, Jerry, the market, is going to go down. Well, fine. There's more money to be made in downtrends than there are in uptrends, and you make it quicker. So it doesn't matter which direction the market is trading. But the thing is that before you start putting your money into the market, it's strongly advisable that you put your strategy down on paper and you paper trade. So what this means is that you could literally just in your mind say, okay, based upon what I understand about trading and investing now and with my trading plan and everything that I've got going on, I'm going to buy shares of, let's say, Microsoft today. And what you would do is you would just put it on paper, put down the price you would buy it at, and imagine it was a real trade. And then simply record it. And these are imaginary trades on paper. And what it will allow you to do is it'll allow you to learn from your successes and your failures. So once you put real money on the line, the experiences and the lessons that you've learned from months of paper trading and your own trading plan will serve to give you confidence in your decisions. I always tell new traders to at least paper trade for 90 days. I mean, really you should, because it'll give you an opportunity to see how your strategy is working. Now, it is true, some people will say paper trading is not effective because you don't feel the real pain involved if you actually lose. And that's true. The emotions that you're going to feel when you use real money are wildly different than what you're going to feel with paper trading. You're not paper trading to learn the emotional side. You're paper trading to learn the trading system side. You're making sure that your entries and exits are proper. So you won't be able to control your emotions during the paper trading time that you focus on that. But you will be able to further refine your trading plan and make sure what you're thinking is good before you put out your hard-earned money into this market. Don't just throw out a bunch of money in the market and hope that your brand new trading plan that you haven't tested is going to work. That's a sure way to lose your money. Rule number 10, paper trade, paper trade, paper trade. I got to tell you, one of the things I love doing here at Follow the Money is helping new traders. And if you're a new trader out there who's just getting started, I want to encourage you to do a few things. Number one, obviously, go download this completely free PDF at followthemoney.com/trading rules. This is but like I said, a 12 or 13 page PDF that you can download. Each of these rules are written out so you can completely see them. You can learn exactly what we have learned over the years to become a better trader and to actually grow your trading account or your investment account. The second thing that I would encourage you to do is also take a look at followthemoney.com/subscriptions and see if there is a plan there that meets your particular needs. We are here to educate and coach individual traders and investors. We've been doing this since 2010. I've been trading the market since 1996, and we really want to help you. So I would encourage you to reach out to us, followthemoney.com. And if you have any questions, you can always click on the contact tab, reach out to us. We're more than happy to hear from each of you. So be sure to go to followthemoney.com/trading rules, download this completely free PDF report today, and get on the fast track to becoming a better trader or investor. Hello, friends. Jerry Robinson here from followthemoney.com. Has this been a hot summer or what? Ever since I was a kid, I have just loved the summer months, and this summer has been no exception. But now that we are in the month of August, summer's almost gone. And here at Follow the Money, we have decided to celebrate the final days of summer with a blowout special on our incredible Gold membership. Try out our Gold membership for just $1 for your first 30 days. As a Gold member, you will get access to many of our best investing, trading, and income resources, including full access to our Multiple Streams Academy, which is like an income university that provides you with online courses in 22 different income streams that you can create both now and in retirement. The only thing standing between you and more income is an idea. Let followthemoney.com introduce you to a whole new way of thinking about your finances, investing, and income creation. Try out our Gold membership for just $1 for your first 30 days today. This offer comes with a complete 100% money-back guarantee, so you have nothing to lose. Simply go to followthemoney.com and click on the Plans Pricing button, and then choose the Gold membership. At checkout, you will need to enter a coupon code, and that coupon code is the word GOLD, G-O-L-D. Don't let another summer slip by without you taking action to improve your financial situation by creating a new income stream. This is a very limited time offer, so act now. Go to followthemoney.com and use coupon code GOLD to get your first month of our Gold membership for just $1. Or if you prefer to order by phone, simply call us at 800-609-5530 and select option 1. Don't delay, and I'll see you on the other side. All right, friends. Well, that brings us to the end of our program. Thank you so much for tuning in and enjoying our broadcast right here each and every week. Followthemoney.com is where you can find us. And as always, I'd like to leave you with a final word, this time a little different. I want to talk real quickly, kind of let you know about something. For many years, I have been leading a Bible teaching ministry. You can find that online at truerichesacademy.com. And we are so excited. We are going to begin a brand new podcast called the True Riches Podcast that's going to be available at that website, truerichesacademy.com. So those of you who know that I'm a fellow believer, I'm a Christian, I've also been teaching the Bible for many years, and we're going to begin a podcast to really focus upon Bible teaching and also talking about current events from a biblical perspective. If that's something that you would like to hear about or learn more about, simply go to truerichesacademy.com and be looking there for the first podcast to be coming out very soon. I want to encourage you to check that out, and I want to thank you again for tuning in to Follow the Money Radio. It's an honor and a privilege to serve you right here each and every week. Until next time, don't forget, if you want the truth, just follow the money. Have a safe and prosperous week. We'll see you right back here next time. God bless.
All of the information contained on the Follow the Money podcast is strictly for informational and educational purposes. It should not be construed as specific investment advice. The views and opinions of our guests and sponsors, including Tom Cloud, are their own and do not necessarily represent the views of FTMDaily.com or Robinson Media Group, LLC. Jerry Robinson does hold an insurance license and at times may offer consulting on life insurance and fixed retirement income products. Follow-up, individualized responses to email or phone requests that involve the rendering of personalized investment advice for compensation will not be made absent compliance with state investment advisor registration requirements or an applicable exemption or exclusion and applicable insurance regulations. Past performance is not indicative of future results. You should be aware of the real risk of loss in following any strategy or investment discussed on the podcast. Remember, never do your financial planning through podcast or radio. It's your money. Be wise. Do your due diligence and always consult a trusted financial professional before making any financial decisions.